Somewhere in your feed right now, a fund is advertising a 60% yield. The number is not a typo, and it is not a scam. The checks really arrive every single month, and many of the people cashing those checks are losing money. Both things are true at the same time, and the machine that makes them both true fits in one sentence. This fund sells away its best days and mails you the proceeds. Start with the machine's oldest part, the covered call. An investor owns 100 shares of a stock and sells someone else the right to buy those shares at a set price within the next month. For selling that right, the investor collects cash today, called the premium. Income now. In exchange, if the stock rises past the set price, the shares get called away. The upside above that line belongs to someone else. A covered call ETF does this at industrial scale. One well-known fund has sold at the money calls against essentially its whole portfolio every month since 2013. And the newer single stock funds run a variant called the synthetic covered call. They do not hold the shares at all. A pair of options builds a position that behaves like the stock, and then the calls are sold on top of that. Same cap, same premium, no stock. Now the arithmetic. Say a stock trades at $100 and a one-month call at the $100 strike sells for $3. Selling it produces 3% of cash in a month, which the fund can advertise as an annualized distribution rate near 36%. That is the entire origin of the headline number. It is real cash, produced monthly, priced by the options market. Why would a premium be so rich? Volatility. An option on a calm utility stock sells for pennies. An option on a stock that swings 10% in a week sells for a fortune. That is why the single stock funds on the wildest names advertise the wildest rates, 60, 80, even 100%. The market is not donating that money. It is paying the fund for absorbing the stock's risk, while capping its reward. Play the month forward 3 ways. If the stock sits still, the fund keeps the $3. That is the good path. If the stock falls to 90, the fund loses 7. The premium softened the fall. Nothing more. And if the stock rockets to 120, the fund gets its $3 and not a cent of the $20 rally. One path wins small, one loses big. One watches the best month drive past the window. One more piece of plumbing. When the month's premium is not enough to cover the advertised payout, some funds top the check up with the shareholders' own money. The statements call it return of capital. The check looks the same. The fund's share price quietly steps down to match, because part of what was mailed out was not income at all. A quick word on the tax paperwork, because it feeds the marketing. The return of capital slice is not taxed in the year it arrives. It lowers the holder's cost basis instead, which defers the bill until the shares are sold, and promotional material often presents that as tax efficiency. The rest of the distribution is generally taxed as ordinary income, not at the lower qualified dividend rate. So part of the famous check is capped upside in disguise, and part can be a tax deferral wearing an income costume. So the paradox resolves cleanly. The distribution rate is real, and it is manufactured by selling the stock's future to fund the present. Hold the machine through a full cycle and a ratchet appears. In crashes, the fund falls nearly as hard as the stock. In recoveries, its rebound is capped month after month, because the upside has always already been sold. Down with the elevator, up by the stairs, with a toll booth on every floor. And the honest version cuts both ways, as always. In flat, choppy, sideways markets, harvesting premium while the index goes nowhere is genuinely the strategy's best environment, and it can beat plain ownership there. The pattern in the data is about full cycles. Markets that eventually trend, in either direction, are where the cap quietly compounds into the gap you saw in the opening chart. Now, the documented record. The oldest large covered call ETF has paid its monthly distribution without fail since 2013. Over that same stretch, its share price has lost roughly a third of its value, while the index it writes calls on multiplied. Total return, with every distribution counted, stayed positive, and still trailed simply owning the index by an enormous margin. The checks were real. The gap was real too. The single stock versions compressed that decade into months. One prominent fund built on a famously volatile automaker advertised distribution rates near triple digits. Its share price fell far enough, fast enough, that within about a year of launch, the fund executed a reverse share split to keep the price presentable, while the distributions kept flowing. Holders who spent the checks watched the balance shrink underneath them. Nothing malfunctioned. The losses are the machine's documented cost, paid by whoever holds it through the wrong market. So, the one-line version. A covered call fund's distribution rate tells you what it pays, not what it earns, because the payment is financed by selling the upside. Yield is not return. This has been how it actually works, from Finance in Review. Educational content only, never investment advice.